Hey everyone, me Kevin here. You might remember back in 2019 when we had something crazy happen called the inversion of the yield curve. And that sounded really terrible, especially in the tone I just said it in. But it was a big deal. Back in April and March of 2019, we were really concerned that the inversion of the yield curve, which was basically a time when all of a sudden 10-year bonds are trading with a lower yield than 2-year bonds, which is really weird because you think if you put money away longer, you would make more money. But that was opposite for a moment. That inversion was seen as a big signal that a recession was due within 12 to 18 months. That is also kind of spooky given that 12 months later we had the pandemic and a recession, but let's just call that a fluke. In the meantime, we have a recent shift happening, one that really started after Jerome Powell opened his yabber trap again yesterday. And it's right here. Take a look at this. It is the 5s and 30s in treasury yields all of a sudden crashing. This is a collapse or narrowing of the spread between the two. And this is a pretty dramatic plummet here. You don't see those plummets really anywhere else on this chart going back this last year here. This is a pretty big move to the downside. In fact, when I take a look at the quote, as far as exactly what Bloomberg says about this, they said, quote, "A significant narrowing of yield curves is a strong indicator of an impending recession. While we are a long way from inversion, the narrowing curves are indicative of an unhealthy outlook." And folks, this got me really interested in trying to determine what the heck is going on and what does that mean and what this means have to do with what's happening in the stock market today. Because boy, oh boy, today is one of those days I wish I had been live streaming because we have a little bit of a start of something happening here, but we're gonna talk about it in this video. Right after I mention the sponsor for this video, which is me. Check out the amazing programs linked down below for the amazing programs on building your wealth. I'm going to be adding some spectacular content for free and for all course members by the end of July. So over the next 6 weeks, we're creating new content, specifically in the Stocks and Psychology of Money course. We're gonna be going into technical analysis and options trading, and we'll be adding new content to the YouTube and real estate courses as well. We're super excited about that. All right, folks, let's talk about what this 530s thing means. All right, so I realize that most of us probably aren't bond traders and treasury enthusiasts, especially since most of us are like, oh, how much can I get paid on a 5-year treasury? Oh, 0.84%. Yeah, well, that makes sense. Not, but anyway, there are reasons banks do it and companies do it, risk-free asset, blah, 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 whatever. But why practically does this happen? Like why all of a sudden did we see this plummet and what does it signal? Okay, so here's how this works. The more we fear short-term inflation, the less valuable 5-year treasury bonds are going to be. This makes sense because 5 years generally kind of short-term. So if we have more inflation, the value of those 5-year treasury bonds is going to go down, which drives their yield up. Does the opposite, yields and prices, right? So the more fear we have for short-term inflation, the more 5 years get punished, 5-year bonds get punished. The less we fear long-term inflation, the more long-term treasuries get rewarded, like the 30-year. So in other words, 30-year goes up in price, 5-year goes down in price, and when we look at yields, we flip that and we get an inversion. Okay, now that might be complicated. Don't worry about it. Basically means 5-year yields going up, 30-year yields going down. More people moving into the longer term bonds. Now, this signals something in the market, but it's important to know where this came from. It came from Jerome Powell, basically. Jerome Powell said, we're acknowledging more short-term inflation. This was a change. This is something that we've been waiting for Jerome Powell to say. We've been waiting for the real talk of Jerome Powell going, yeah, inflation actually is worse right now, and it's worse than we expected. But Jerome Powell reiterated that he believes we have more of a risk of seeing disinflation or less inflation in the long term. And so that's potentially why we're seeing this all of a sudden big drop in that yield curve. But there's another thing this signals. It signals a potential real economic slowdown. Remember how Bloomberg was quoted to say that a narrowing in the curve implies a slowdown or maybe even a recession once you get towards inversion? Or it implies just slower growth and a not so positive outlook? Well, where do we go and where do we flee, or what do we flee when we expect less growth? Well, make it very simple. Recovery stocks like retail and restaurants and travel have done very well since the vaccine came out. But since then, we believe that stimulus and the vaccine have almost priced these companies to perfection. At the same time, we've seen a massive run in commodities prices like lumber, copper, metals, and these other commodities that historically just haven't done so phenomenally well. So these two sectors that usually aren't like too hot have done very, very well for about the last 6 to 8 months. In fact, take a look at copper right here. And well, this is actually commodities in general. You can see that they've been declining for really the last about 20 years almost here, 18-ish years. And so we've been in this declining pattern, but we've recently had this bullish breakout, which is really positive for commodities. But what's been actually happening within the last couple of weeks, specifically today? We've started seeing commodity prices rotate down. We see the same thing happening at copper and at lumber. Copper and lumber have started to rotate to the downside. This is really their first rotation to the downside in basically a year. I mean, this is a 1-year chart, so in a year. And we've started to notice the same thing happening with recovery stocks today. Take a look at recovery stocks right here. We've got today, Red Robin, Dave & Buster's, down 4 to 5%. We've got Citigroup and JP Morgan Chase. Industrials like Capital are down. We've got, here's JP Morgan, here's Carnival. We got a lot of recovery and financials. Here's Credit Suisse, down today on this fear about a potentially slower growing economy. So commodities are chilling out, the dollar's getting stronger, financials like banks are having a little bit of a weaker time, although they do have stress tests coming up next week, which we expect to be very good for the banks because they got a crap ton of cash. So we don't think the stress tests are going to be a problem at all for the banks, which should be bullish for the banks. But as a longer trend, this potential narrowing of this 530 treasuries and a signal of potentially slower growth could weigh on commodities and recovery stocks. That is, we could see commodities and recovery stocks trade down. And now here's something interesting that happens. When commodities and recoveries trade down, guess what usually does really well? Think about human psychology. If all of a sudden the sectors you're in, like commodities and recovery stocks, start slowing down and the entire economy slows down, but you want some growth, like growth at all costs, so to speak, you got to have some growth, where do you go to get growth? Well, usually you go to growth stocks. And what's crazy is, at the same time as we have that big narrowing in the 530s, that yield curve I showed you, take a look at what kicked frickin' butt today. Now keep in mind, I'm gonna mention AMC here as well. Of course, AMC did phenomenally, but take a look at what did so well today. We had electric vehicle companies do very well today. SunPower do well today. Twilio, Tech do very well. Enphase do well. Cloudflare do well. Trade Desk, Pinterest, Square, Redfin, Nvidia, SoFi, Tech, Lemonade, Zillow. It's the higher multiple, more tech-style stocks did very, very well today. And it's possible, at least this is what's being talked about, that because tech has really suffered for the last 6 to 8 months, because there have been other opportunities, we could be rotating into a period where all of a sudden tech comes back into favor. And so in other words, if that narrowing yield curve is a sign of the economy slowing down, is a sign of folks being a little bit more nervous about short-term inflation but not worried about longer-term inflation, then we might see a stock market rotation between now and, I've mentioned this before, September and October, into tech and growth as other aspects of the stock market begin to slow down. Now, this is great news if you're in tech, but if you're not in tech yet, it's not too late. In my opinion, you've got some relatively cheap opportunities to get into, especially if you look at their future PEs. Some of my favorite cheapest companies I'm looking at and investing in right now, when I look at their 2025 forecasted PE ratios, price to earnings ratio, the cheapest ones, Google, AMD, by far the cheapest. Then you've got Shift Technologies, which is really only a growth play because it's so rather undervalued. It's so darn cheap. Otherwise, it's more of a value play. But then you also have Etsy, Pinterest, and AMD. Google and AMD sitting around 13 to 14 times future earnings. You've got Etsy, Pinterest, Apple, those sitting around the low to mid 20s. And if you want to mix in a little bit of a higher valuation, you could look at companies like Airbnb, Peloton, Nvidia, Tesla, Enphase, Matterport, and Trade Desk. Those are some opportunities as well. And personally, I'm really eyeballing Coinbase, though I'm mostly looking for the bottom of cryptos to jump into Coinbase more heavily. So I'm gonna exclude Coinbase from kind of like the tech world right now, and instead we're gonna be looking at some of these others. Now, this is also very important for me to pay attention to because I have a lot of money in leaps for tech. And what I'm looking for is a big rally that comes very, very quickly in tech. And what I'm gonna do when that big rally comes is I'm going to dump my options and I'm gonna turn them into shares. Now, I've been waiting for this moment since April 20th. I don't think it's around the corner, but it might be. So we gotta pay attention to it. And what Jerome said and how the bond market is reacting is a big sign that what I've been talking about for a few months could be coming to fruition. Now, even though I'd like to be right, so that way I can remind you all to always check out my amazing programs on building your wealth, I wanna be clear, this is so far just today. All of this could unwind tomorrow and it could be back to a tech bashing. So you never know. But I'm going to pay attention to the narrowing of the 5s and 30s. That chart I showed you at the beginning of this video, and I'll pull it up one more time, just so you can know exactly what to pay attention to as well. Because if we continue to see this narrowing, it's seen by Wall Street as a signal that growth is slowing. If growth is slowing, like overall economic growth is slowing down, which actually, if we look back at a video that I posted 2 or 3 days ago about a rotation coming to the stock market, I showed that Google search trends were not really growing anymore for people spending money. They were kind of flatlining. Then this could really all be reiterating everything else. That, okay, we started reopening, people spent money, but now people aren't spending like excessively more than they have been spending in the last few months. So search volumes are flattening in terms of changing search volumes. People have taken the foot off the gas, so to speak. We're seeing bond yields narrow here, which is not a very bullish indicator. It's a slow growth indicator, and that could lead people to get out of the potentially overvalued commodities or potentially perfectly priced recoveries and rotate back into those tech stocks. Now we'll see, again, don't have a crystal ball, but these are some very important indicators to watch for, I wanna say, the next 6 months in the stock market. For me, 2022 is the year of crypto. That's when we're going to the frickin' moon. But for right now, I wanna ride this tech wave that I think is coming, and I'm all in on it right now. So we'll see what happens. I'm paying attention to it. Make sure to subscribe to get more content like this. Thank you so much for watching. Check out the programs linked down below, and folks, we'll see you in the next one.